Yes, sir. Can hear you.
All right. Good evening,
Yes,
everyone.
sir.
Happy New Month. So you're welcome once again to Equity Professional Limited, and the paper we're having today is Advanced Audit Assurance and Forensic. Uh, we are looking at a new chapter. We are moving to chapter 7 today, and in chapter 7 we are discussing planning, or better still, we call it the audit planning. Okay, so this is the beginning of a new phase of the syllabus, because from this stage to the next stage to two other stages, we'll be looking at what we call audit engagement cycle. Audit engagement cycle. What does that mean? So that those are the processes it takes for an auditor or an engagement partner or an audit firm to complete an engagement. So that those processes that the audit engagement follows till it's completed, it is known as the audit engagement cycle. So the cycle starts with planning, audit planning. Then it moves on to gathering of audit evidence. Then moves on to evaluation and review of audit evidence. Then moves on to reporting, and that is the cycle, and that's where we are going to go in this class. So after this, we go to audit evidence, we go to evaluation and review, then we go to reporting before we come to other aspects of the syllabus. Okay. So without further ado, let's start this class. Now today, the relevant standards that we'll be making use of, one of them is ISA 200, that talks about the overall objective of the independent auditor and the conduct of an audit in accordance with international standard on auditing. So basically, what this one is saying here is that as an auditor, right, you need to have an objective that you intend to achieve at the end of the audit. For every audit, you should always have an objective. So what objective do you want to achieve should be the basis for any auditor that intends or that has been charged with the responsibility of conducting an audit engagement. So that must be stated, right? And the objective, please note, the objective should always include ensuring that the financial statement that is being presented or being examined by the client management for by the auditor is free from any material misstatement. Okay, any material misstatement, either from fraud or from error. All right, because there are so many intended users that rely on the auditor's report at the end of the day. So he needs to be sure that whatever his audit opinion is, right, he's been able to provide a reasonable level of assurance that the financial statement examined do not contain material misstatements. So what do we mean by that? So material misstatement, right, could mean when the financial reporting standards are not being adhered to. Okay? The accounting principles are not being adhered to. That could be one. All right? Falsification of information or falsification of balances, account balances in the financial statement will also be one. Okay? Providing misleading information or misleading figures in the financial statement will also be one. Right? Inadequate disclosure. Inadequate disclosure of information in financial statement can also be one. And lastly, the presentation of the financial statement not in line with the IFRS could also be a function of material misstatement. All right. So anytime they talk about material misstatement, please always look at it from all of these aspects that I just read out. All right. So we move on. Now, one thing you also need to note here is that as an auditor, right, when you are performing your audit, there are certain requirements that you need to have. Okay, you must have some what expectations. What are the expectations? Number one, you must comply with all the ISA relevant to the audit. Now, mind you, there are so many ISAs, right? There are so many international standards on auditing. But I hope you know and you agree with me that it is not all the international standard on auditing that are applicable in every audit engagement. All right? Do you agree with me, class? That is not all the international standard on auditing that are required in every audit engagement. Do you agree with that?
Yes, sir.
Okay. So for instance, it's not all audit clients or audit engagement that involves group engagement. That is group audit. So when your client does not have a group of companies, that means group audit will not apply. That means ISA 600 will not apply. That's just an instance, okay? Then another thing you also need to note here is that another expectation is that you must also ensure that you comply with relevant ethical requirements. You must make sure that you do what? You comply with what? Relevant ethical requirements. What do we mean? Now, remember in chapter 3, when we talk about rule of professional conduct, there are certain principles, there are certain ethical values that every auditor must possess. All right? There are certain ethical values that every auditor must what? Must possess. And we look at them extensively in chapter 3. So what are those ethical values? Number one, you must have integrity, you must be independent, you must be seen to be independent, right? You must have, you need to demonstrate due competence, skill, and care, right? You must be of good professional behavior, right? You must have integrity, you must be objective. All of these were discussed in chapter 3. And the same thing still is applicable here. So you must demonstrate that to a very large extent. All right. The other thing that is also necessary for you to go far, for you to be able to do a good job in the audit, is that you must plan and perform the audit with professional skepticism. That is an attitude. So as an auditor, you must have this attitude. Okay? It's an attitude that is expected of an auditor. That is, you must be able to look at your client, right? So rather than for you to be having um rather for you to have a positive mindset to your client, you must have this skeptical mindset. You must have this doubt that what if this my client spring springs surprise? Okay, that is what if your expectation is not met when you go for this audit. You must always have that at the back of your mind. So when you talk about having you having an attitude of operational skepticism, what it means is that you must have a state of mind, a probing mind, that is for every information, every document, everything that the audit client or the client management presents to you, you must always ask questions. Ask questions. Don't just take it and say, okay, I think it's fine. Because if you don't ask questions, and let me shock you, when you go for audit, you'll be amazed that it is what you ask that they will give you. Sometimes they know that you need A to Z, for instance, but if you don't ask, they will not give you. So you need to ask. When you ask, then the client will reciprocate. And when they reciprocate, you have a duty to check through, to critique whatever information that is being presented. Remember in chapter 1, we talk about limited level of assurance. What do we say is limited level of assurance? What we said is that rather than for them to give you what you need, they will give you something that is like a replica. Okay? They give you a possible information, meaning something that is related to what you wanted. And they'll tell you, for instance, you wanted orange, they tell you that no, take apple. When you ask apple and orange, both of them are fruits now. So one can substitute for the other. You understand? But you need to insist that this is what you need. Okay? And if they cannot give you what you need, they must give you reasons why they cannot share that information with you. So that is what we mean by having an attitude of professional skepticism. So you don't just take everything they tell you hook, line, and sinker. You must be able to ask questions. If you don't ask questions, then you will not get anywhere. So you need to have that attitude. You must cultivate that attitude of asking questions from your clients. All right. That's what we mean by that. Then, above all, you need to exercise professional judgment in planning and performing an audit. Okay, you need to do what? Exercise professional judgment in planning and performing. So, how do you get to this point? Now, your professional judgment is acquired over time. Okay, so the more you engage in client engagement, right, or client audit, right, the more the more you get, you sharpen your professional judgment, because your professional judgment is also a function or a factor of your exposure. All right. So the more you deal with clients, the more you handle clients engagements, right, the more you become very uh you become very good at your sense of professional judgment. Okay. And another thing that is also very, very important when you are doing the audit, because everything in audit is subject to the availability of information. And that information must be sufficient and must be appropriate. So you must be able to obtain sufficient and appropriate audit evidence to substantiate your opinion, because it is the evidence that you're able to gather that will form the basis of your audit opinion. So if you have not gathered sufficient and appropriate audit evidence, that means there's every likelihood that you are going to issue an inappropriate audit opinion. So these are the expectations of the auditor. All right. Any question before we proceed? Questions, comments, observations? Are we there?
Yes, sir.
Yes, sir.
Any question?
Yes, sir.
Please ask your question. I'm listening. Ask your question. No question again? All right. Let's continue. So if you have any question, please you can ask at any time, right? So that you can call my attention to it if you have any question. Now, like I said, I made mention of audit engagement cycle. Now, first and foremost, I want to ask, have you been taught the audit approach? Hello?
No,
No,
sir.
sir.
No,
Okay.
sir.
So what topic what chapter did you discuss last time on Sunday? Last Sunday?
Internal audits.
Internal audit and outsourcing.
That's what you discuss. Okay. So, well, the facilitator knows what she's doing. She will take you through that time. Why I needed to talk about that is that for the planning stage, right? First and foremost, as an auditor that is taking charge of an audit engagement, the first you need to know is to first of all gain understanding of your client business. You must obtain understanding of how your client business operates. Okay, so you need to know what industry or what sector is your client business functioning. All right, you need to know what are the regulations that guide your client business. Right, you need to know how the business operates. What are the intricacies? What are the process? What are the procedures? Because you might have two banks, and to shock you, to surprise you to know that these two banks, they operate two different processes and procedures that are not similar at all, and they are both banks. All right. So you must gain understanding of how your client business operates. You must understand the workflow, the flow chart. process flow. All of these must be, and you know, there's times you have some clients that their processes and procedures are very, very complex. So you must take time to first of all understudy it. And that is one of the reasons why I talk about it in chapter 5, when I made mention of the fact that as an auditor, when you are tendering, the first you need to do is to do what we call a preliminary audit risk assessment. So what that does for you is that it gives you an overview of what it entails to audit that particular client. What should you look out for? What should be the things you need to look out for when you're auditing that client? And that is where the preliminary audit risk assessment comes in. All right. So aside from that, you also need to know the SOPs. What are the process and procedures? How do they treat their transactions? Okay, you need to request for the SOPs, standard operating procedures, because that's going to guide you on how the business operates. It will amaze you that you have to, like I said, you have two banks and they treat their transactions or their processes differently. And what you should look out for is the SOP. Are they deviating from the SOP? Because when you read and understand the SOP, it's going to facilitate also your audit engagement. It's going to make you to understand the engagement better. All right. So when you get there, these are the things that you need to first of all request for. Okay. Upon determining, upon signing on the letter of engagement or engagement letter, the next for you to do is to obtain this document. All right. And if you have an outgoing auditor, like we discussed in chapter 5, it will be noteworthy, right, to request for the audit working papers from that outgoing audit firm, so that will give you an insight into what to look out for when you start to audit that new client. It's very, very important. Okay, it's very, very important to know all of this. All right. Then that will also inform you on the nature and type of audit tests and procedures. The audit tests that you are going to perform in that client business. Then you need to also know how the regulations, the changes in regulation, how the economy, how the laws, how they impact your client business as well. Okay? You need to know. Remember, Nigeria this year now, last year they passed the new tax act. At least there were 4 new tax laws that were passed, right? And these laws have become effective from 1st of January 2026. So, and it cuts across every sector of the economy. So as an auditor, you need to know which of these laws and how these laws will impact your client business. Okay, you need to know, you need to have that understanding. All right. Then also, when you are done with all of this, with this insight, right, you also have you can have engagement, you can have some interviews as part of your ways of obtaining sufficient appropriate intelligence from your client by interviewing your clients, management, or process owners. Okay, that will give you insight. Then, when you are done with all of this, once you have this understanding, you can now draw up your audit plan. All right. Now, remember, not no two businesses or no two organizations are the same. So in some organizations, you will need, because of the complexity, because of the coverage, because of the attendance location of that client, right? You might need to face your audit, right? Facing means you do an interim audit first. Then you come back later. That interim audit will be done maybe half year, okay, in the middle of the year, to have an insight as to what the year end will be. Then at the end of the year, you now do the final audit. All right. There are procedures for each of the whether you are using interim audit or you are using final audit. There are procedures you need to follow. All right. Then you need to know which of those procedures are applicable for the type of audit that you are trying to do. All right. Then at every time, like I said, before you draw up your audit plan, you must have drawn up your strategy. How do you want to go about this engagement? And that is what I meant by that chapter 6, the audit approach. Remember, the World Cup just ended, right? I don't know how many of us had time to watch the World Cup. But for those that were able to watch the World Cup, you will agree with me that every country that participated in the World Cup, every country I say, they had a strategy, they had a plan that they will win the World Cup, right? But only one country can win it. Okay? Only one country can win what? Can win it. Out of 48 countries that participated in that World Cup, only one country won the World Cup. And you could see, for those of us that watched the match, like I always say, and I'll say it again, when you're talking about advanced audit assurance and forensic, please note that in every aspect of our lives, we have these elements that relates to audit and assurance. All right. And again, it's important to also point out to us that every other paper you are writing in ICAN, from your foundation days to the professional stage, for you to be a good facilitator in advanced audit assurance and forensic, you must be able to juxtapose. You're able to draw inference or inferences from all these other papers in the course of you trying to marshal out your points or try to make your students to understand what you are trying to say. Okay? So that is that. You must have that strategy. And one thing you need to note again is that the audit plan is not static. Okay? The audit plan is not what? Is not static. You might say that you want to start from A. When you might set out that from your office, audit firm, say you are starting with A. You get to the field, you see that if you start from A, you are not going to have a good outing. So you might need to change it. So that means your audit strategy should be what? Should be flexible. Okay? Should be what? Should be flexible. So your audit strategy, your audit materiality, your audit plan, all of these must be flexible until the only time they cannot change is when the engagement is completed. But while the engagement is still on, these that I mentioned remain what? Flexible. Okay? They are not static, right? So we need to also get to knowing that. Now, I've talked about you trying to understand how your client business operates. Okay, I've talked about the overall audit strategy, how you want to go about the engagement, right? We'll still talk more about that. Then another thing you also need to know, all of this I'm discussing is still at the planning stage. All right. So other things you need to include in your planning activities is the resources that you're going to use. Before you set out from your audit firm, you need to know who and who, which we discussed in chapter 5, who and who will be in your audit engagement team. And when you are selecting the members of your audit engagement, you are not doing it because of sentiment. You are doing because you know the people that you are going to select, the people that are going to make up that audit engagement team. They have the competence, okay, to deliver. All right. And aside from that, they must give you all the resources, laptops, audit tools, whatever they need to be able to perform the engagement. All right. Then all of this needs to be put in place. There must be proper supervision, there will be proper monitoring, and from time to time, they need to keep assessing the risk. Okay, you need to keep assessing the risk because the risk the audit risk, right? We'll talk about that as we go on. We need to assess the risk, and all of that needs to be put in place. Now, once that has been done, right, we draw up the audit plan. So, what is the audit plan? So just like for for us that are in this class now, I want to believe that at the beginning of the year, you had a plan that you want to become chartered before this year runs out, right? And in your plan, you have marshaled out how you want to achieve that goal because it's a goal, right? Now, the same thing is what the auditor will also do. He needs to draw up his plan. So, what is an audit plan? So, an audit plan or a plan is a course of action that is decided in advance to achieve a stated goal or objective. So, like I said, for those of us that are in this class now, it's not by accident that you are here, right? You have planned, you thought of it when we did Happy New Year in 2026. You had it at the back of your mind that come December 2026, I would have become a child accountant. That is the goal that you have set, right? That means you have a plan. Now, some of our plan may be that, okay, maybe let me read on my own. I've done that before, it did not favor me. Let me go to physical class. I've done that before, it did not favor me, right? And some will say, okay, all I just need is just a little refresher, right? I don't need to be physically present in a class. Number one, maybe because of my job, maybe because of other things. I want something that is flexible. So you enrolled, that's how you find yourself in this class that we are now. So that is typically what a plan is. A thing that you have decided earlier, you have planned ahead of how to achieve that goal. That is what we call the plan. And the same thing that we are looking at when we talk about the audit plan. All right. Now, as an auditor, the main essence, the plan the auditor will always have is that he must ensure that at the end of the day, when he's done with the report and the report is published, that there is no material misstatement in the what? In the financial statement that has been what? That has been reviewed. All right. So that is that. Now, in drawing up the audit plan, right, there are certain things that the auditor will need to consider. One of it is the audit risk, right? The second one is the materiality, audit materiality. The third one is the client environment, particularly when the client operates in a computer-based environment, okay? So these are the three things that the auditor will need to factor whilst is drawing up his audit or our audit plan, all right? Now, the audit plan includes a description of the nature, timing, and extent of the planned risk assessment procedure. Like I said, as an auditor, the risk we are looking at here is that the risk that the auditor will not issue an inappropriate audit opinion. That's the risk we are looking at. Okay, I take it again. The risk we refer to here is the risk that the auditor will not issue an inappropriate audit opinion because there are so many intended users that await this audit report. All right. So that is the reason why, as an auditor, you need to gain understanding of your client business, as explained in this ISA 315, talking about identifying and assessing the risk of material misstatements. Okay. Number two, there should be a description of the nature, timing, and extent of planned audit procedure at the assertion level. All right. So you need to set out how you intend to carry out the audit. How long will it take you to do the audit? You know fully well that audit cannot take forever. It must be time-based or time-bound. So you need to agree the timing with the client management, and you must work with that timing, right? You must do what? You must do all it takes to work with what? With that timing, right? And in that your audit plan, you need to also plan how you are going to perform. First of all, you are going to obtain your information, that is, obtain sufficient and appropriate audit evidence. How you are going to perform audit test, all right? And you're going to talk about how you are going to ensure at the end of the day you were able to conduct an audit that is what? That is efficient and that is what? Effective on behalf of the what? Of the client. All right. Then the next thing you need to also look at is still on the planning, right? We are looking at another standard, which is ISA 300. The 300 is talking about the planning of the audit proper, that is planning and audit of financial statements. It talks about the overall audit plan. Now, as an auditor, like I said, the main goal is to ensure that you're able to perform the audit efficiently and effectively. All right. So it also entails that when you start the audit, you need to come up with a document known as what? The audit strategy memorandum. You come up with a document known as what? The audit strategy memorandum. Another name for this is audit planning memorandum. Whether you call it audit strategy memorandum, audit planning memorandum, it's the same thing, right? Now, what is this document? So this document sets out the planning decisions that have been decided before the commencement of the audit. I take it again. This document contains all the planning decisions that have been decided before the audit begins. We call it the audit strategy memorandum or audit planning memorandum. Some of the information that you have in this document are: number one, the assignment objective and the report will be issued. So for each, like I said earlier, for each engagement, you must have your object, what you intend to achieve, and the type of report to be issued. Number two, it contains the audit timetable. That is how you intend to go about the audit, such that at the end of the day, you're able to deliver on your timelines as agreed with your client. That means your timeline is when the audit report will be finalized, signed, and what? Published. All right. Then also in this audit planning memorandum, it contains if there has been changes, the auditor would like to know if there has been changes in the organization since the last audit. Now, the last time the audited some organizations now were last year, right? Before the new tax law takes effect. Now, the new tax law has taken effect from January 2026. So, how has this law impacted the business? So, as an auditor, this is just a type, right? I'm just giving you an instance. This is just a type of changes that we are talking about. How has these changes, how have these changes, how have they impacted on your business as a client? The auditor will need to ask you. Then also in this audit strategy memorandum, it contains key financial ratios from the previous years. Remember, when you're talking about ratios are key performance indicators of how a company has performed in the outgoing year or in the year under review. Okay? So before a company fails, the company does not just fail. There are indices that need to be monitored. There are indices that point out to the public that if these indices are not controlled, in no time, this company will fail. These indices are what we refer to as the key financial ratios. Okay? So some of the key financial ratios, for the banks, they have what we call the camel that they use, right? So for organizations, right, they have different ratios, set of ratios. One of those ratios that you need to use is the one that has to do with liquidity. But as a business, you must always be liquid. Liquid means you're able to perform your operational activities without any hindrance of what? Funding. For instance, you're into manufacturing, there is no excuse to say that you are not producing because you don't have money to buy raw materials. That should not be the case. If that is the case, that means the company is having issues or the company is having some challenges which needs to be what? To be addressed. So your liquidity ratio is very, very key. Right? Another ratio, there are so many ratios there are so many of them, right? I'll just give you an instance. Another one is your gross margin, gross profit margin. net profit margin. All of these ratios are very important. Your ROCE, return on capital employed, is very important. All of these are important. So all of these ratios, these key ratios that serve as indicators of whether the company is failing or is performing, needs to be provided to the auditor before the commencement of the audit. Because that is going to form the basis of the auditor to determine how to navigate or how to go about the audit. Then, it should also include the staff. Okay? The staff. The staff here means the client staff. For instance, in this new dispensation now, it's no longer, it's obvious that most organizations, if not all, they have internal auditors now, internal audit department. So you need to ask your client, do they have internal audit department? If they have, do they have people that are working in that department? Because where you have an internal department in an organization, what it does is that it's supposed to make life easier for the external auditor. Because as an internal auditor, most of the things that the external auditor will come and do, you ought to have done it. You ought to have set the pace. You ought to have collated the information on behalf of the auditor, external auditor. So when it comes around, when they come around, they will not need to stress a lot because most of the information that they will require, you already have it, or you already have them. All right. So that is one aspect again. Then you need to also know whether you are going to make use of experts. Now, experts in audit. Now, I need to also let us know that audit is a very, very dynamic paper. Now, what do I mean? Now, if there are some terminologies that you use in audit, if you use it in normal parlance or in an English class or English environment, it's not going to be the same, right? So let me give an instance. Now, I made mention of the fact that at the planning stage, you need to determine whether you are going to make use of auditor's experts. Now, if I ask anybody in this class now, who is an expert, what you tell me is somebody that is very knowledgeable, somebody that is very vast, somebody that is very intelligent. That's what you are going to give me. But in line with audit, that answer or those answers are not correct. So when I make mention of expert, auditor's expert, it means that the way it has been defined in audit is any organization or individual that has competence in other field outside accounting and audit is an expert. Any individual or organization that possesses competence in other fields outside accounting and audit is an expert. So what that implies is that lawyers or solicitors, they are experts. Engineers, they are experts. Architects, they are experts. Surveyors, they are experts. Right? Gemologist is an expert. Actuarist is an expert. So all risk management consultant is an expert. HR consultant is an expert. IT consultant, they are experts. So all of these set of professionals that I've mentioned, they are all regarded as experts in auditing. So you will not have commenced the audit. You now thought of the fact that, oh, I think I need the work of an expert. No. Before you commence, you need to have decided whether you need the work of an expert or not. And the expert in the big four, you have the expert in-house, right? For the big four, most of the experts are in-house. But for the other categories of audit firm, they need to get them externally. Right? So you need to determine at the planning stage whether you are going to need an expert. But how do you say that you are trying to cook, you are trying to prepare a stew or a stew, you are going to prepare a pot of stew, and the main ingredient, you do not buy it when you are about to start. So at the point of you have already started cooking, I did not buy fish, or I did not buy chicken, I did not buy this one. That should not be the case. So before you started, you should have decided what and what you need. All right. That is another thing you need to, that is also contained in the audit study memorandum. Then again, what are the possible problem areas in the audit and the approach you are going to use to address those issues? Now, you remember, there are certain information that the client's management are not, they don't usually predisposes to giving out certain information to the external auditor. Okay, one of that information is information that relates to directors emolument. Those clients management, they are not predisposes to giving out that information to the external auditor. The external auditor will press, request. They don't present it. I don't know why. This is just an aspect of the information that we are talking about. So auditor must have a way of getting that information from them. All right. Then also, the auditor should also know how many staff will be required from their end for the audit. Not that when they are assigned, that's one person is, we need to get one more person. Oh, this aspect we did not plan, we never thought about it. Auditors don't do like that. Auditors are very organized set of professionals. So before they set out, the number of staff, audit personnel that they are required would have been determined before the engagement commences. So that's how they are going to work, for how long they are going to work, all of that must have been what? Decided before the audit commences. Okay? Then another thing that is also part of the audit strategy memorandum is the attendance location of the client business. So there are some clients that have branches across the world. Like instance is UBA or First Bank, right? That have branches all over the world. So when you are doing the audit of such organization or such organizations, you need to be mindful, you need to be intentional about how you intend to cover all the attendance location. Because one of the primary duties of an auditor, like I explained when we talk about it in chapter 2, was that he must obtain report from branches not visited by them. It's not possible for the auditor to visit all the branches of the organization. For instance, the First Bank now, can the auditor visit over 300 branches within 6 months? The answer is no. So what does he need to do? If he cannot visit all these branches, he must obtain reports from those branches that he has not visited. And that report or those reports plus the one that he visited will form the basis of his audit opinion when he's writing his audit report. All right. They also need to decide what is the mode of communication that is going to deploy when the engagement starts. Will they be meeting from time to time? Basically, will they be using social media tools to converse? That needs to be decided. All right. So, other information. So, those are some of the information that you have in the strategy memorandum. Any question? Question, comment, observation? We are good, right? All right, let's continue. Now, also in the planning stage of the audit, there are two sets of information that you need to also consider or that needs to be considered. One, you have the relevant information. Two, you have the irrelevant information. What is the difference? Now, when you talk about relevant information, what we talk about relevant information, we mean information that becomes handy, that comes in handy, that becomes very useful, that comes in timely, the editor can use when performing the engagement and will be able to arrive at an audit opinion. So he must be able to, obtain that information. That information is what is the one we regard as what? The relevant information. Information relating to the client environment, information relating to the client financial statement, information relating to uh, gaining understanding of how the client business operates, the internal control system, right? The customers, the customers, other agencies, regulators, all of that information must come in handy to the auditor. All right? Because all of this will form part of the professional judgment that will enable the auditor to come up with an audit opinion that is appropriate. All right. Then we have the second type of information we call the irrelevant information. Now, mere using the word irrelevant does not mean that that information is useless. What it means is that that set of information might not be useful for that current engagement because there are several engagements the auditor can perform. But for the one that has to do with audit of the financial statement, this set of information are not or is not required. So this information will be required when he wants to embark on other engagements like agreed upon procedures, right? Review engagements, compilation report, due diligence engagement. This other information that we classify as irrelevant and come in what? And come in handy. All right? Now, like I said, concerning the relevant information, you need some information that relates to, as a matter of urgency, information that relates to the financial. For instance, if the company you saw in financial statement long-term liability, you need to request for the loan agreement to understand the terms and conditions of the loan agreement. Okay, you need to look at you need to look at the revenue. You saw the revenue. You may need to ask, how have you classified your revenue? Does your presentation of revenue, does it comply with the IFRS 15? Does it fulfill all those performance obligations? All of these are what you'll be requesting for when it comes to that relevant information. All right. So we are done with that aspect of planning, right? We move to the next stage. Now, I said that at the planning stage, you need to be mindful of, when doing up your plan, you need to be mindful of your audit risk, your audit materiality, and the kind of environment that your client business operates. Okay, particularly when it's a computer-based environment. So we look at the audit risk. What is audit risk? Now, audit risk, before we look at audit, let's look at the approach. Now, remember I made mention of the approaches that you can use when you want to perform an audit. I'm just, well, we'll still talk about it. I'm just surprised that you've not talked about it because that's supposed to have laid the foundation for this. Yes, it will still be taking. So, the approaches, they are very, very important. How you tend to go about the engagement is very, very important to the what? To the auditor. Somebody is asking a question. Okay. What was the topic? Maybe she just joined. It's actually named audit planning material, but the lecturer said looking at audit planning. So the someone has answered the person. I think the question has been answered. Okay, thank you. Thank you to Madam Temitope, Abi Mr. Temitope. Thank you for that. All right. So continue telling you about the audit approach. Now, currently, right, there are 4 approaches that you can use. Either you use substantive testing audit approach, you use the financial, use the business risk or risk-based approach, or you use the system-based approach. Now, the risk-based approach is one I want to talk about. Now, the risk-based approach in auditing means is an approach where the auditor will focus on the critical areas of the client business. Okay? Focus on what? The critical areas of every business has its area of criticality. Every business. For instance, the bank, the area of criticality in a bank is what? Is the deposit. Okay? If you go to an oil and gas, the area of criticality is their product, the petroleum product that they have in their tank farm. Right? If you go to every organizations, as an auditor, you need to be able to identify what are the critical areas of the business. What that implies is that if those areas are affected, will not survive. So as an auditor, it is very, very important to be able to gain and be able to identify those areas of criticality in a client business so that you are going to focus your energy, you're going to focus your audit engagement in that direction. All right? It's very, very key. That's very, very key. All right? Any question, any comment, any observation? Question, comment, observation?
Yes, good evening, sir.
Please ask your
Okay, so
question.
you mentioned, yes, that sometimes clients find it difficult to release information, maybe like for directors' information. So what do you do in that regard as an auditor
So
when
when
the
you ask,
client is unwilling?
so when you ask for information from your client and your client is not disposed to releasing that information to you, right? There are different things you can do. One of the things you can do is to let they should give the reasons why that information cannot be presented. You need to have that understanding, right? Then number two, you need to let them know that if that information is not provided, it will impact your audit opinion. That is, if you are wanted to issue a clear audit report before, and that information you consider as very, very important was not provided, you might have to change your audit opinion from a clear audit opinion to a qualified audit opinion, which they would not like. All right? So that is what you are going to do. By the time you do that, they'll be able to tell you where the direction that they want you to go. All right? Thank you. Please ask your question.
Oh yeah,
Oluwaye,
not
solution.
question. So I just want to like say something regarding the questions she asked.
All right. Thank
You
you.
needed a director information and they are not giving. So,
Yeah.
sir, with that, is that not a limitation of scope?
That is why I said that if they don't give you that information, first you need to understand where they are coming from. Sometimes you might not know, they might not know the implication of not providing that information. And if you know the point of their points, I mean their justification for not providing that information, then that will now give you the leverage to tell them that this information is considered as vital. And if this information is not provided, it means that there's a limitation. And when there's a limitation, later we have no other option than to issue a qualified or a modified audit report. So if they are good with that, if they are not good with that, they might need to reconsider and say, okay, let's go and reconsider. We'll get back to you. All right. So that is the way to go. Not every client wants to have a qualified, because when you issue a qualified audit opinion, sometimes it poses a signal that okay, something is not right, or some information was not provided, and they will not want to be in that limelight, because once the audit report is out, it cannot be withdrawn again. All right. Hope I'm able to answer your question, Madam Oluwayemi Folusho. Are you able to answer your question, madam?
Yes, that's fine, sir.
All right, thank you. So with that takes after you have been able to to understand what we mean by the risk-based approach, we go to the next level. Like I said, I talk about when you are drawing up your audit plan, 3 factors need to be considered: audit risk, audit materiality, and the client environment, particularly if the client is operating in a computer-based environment. So let's start with the first one, audit risk. What is audit risk? Now, audit risk is a risk that the auditor will issue an inappropriate audit opinion. I take it again. Audit risk is a risk that the auditor will issue what? An inappropriate audit opinion. What do we mean? Now, let me give an instance. So for every one of us, we have phones, right? Now, the phones we have, two things can happen. We don't pray for any of it to happen, but that is the fact of life. Either the phone gets stolen or the phone gets damaged. That is the two things that can happen to your phone. Either it gets damaged due to long usage, it was not stolen, or it gets stolen. These are the two that can happen. right? So that is the same thing. So that risk is there. There is that potentiality that risk is there, okay? You cannot wish it away. You cannot say, God forbid, either of it will happen to your phone, right? The same thing is applicable to auditors too. There's every tendency that any audit report that is issued, there's a tendency inappropriateness. There are some inappropriate information in that report. Okay? Now, but one thing is very, very important when you talk about audit risk. You cannot eliminate the audit risk, but you can bring it to an acceptably low level. You can bring it to what? An acceptably low level. So you cannot wish it away, but it's always there. So one of the things you need to do to reducing this audit risk are what we have been discussing since morning, since we started. If you put all these measures in place at the planning stage, I can tell you for free that your audit risk will have been reduced to an acceptably low level. Now, another thing you also need to note is this. The audit risk that we are talking about, right? You can see it here. Look at it here. And like I always tell us, I do not read from the material directly. I just try to discuss, all right? Look at it here, all right? So when you read the material, you see it there. So your audit risk is made up of 3 components, all right? Your audit risk is made up of 3 components, but the overall end goal of audit risk is to reduce it to an acceptable or acceptably low level. So your audit risk is made up of 3 risks. You have the inherent risk, you have the control risk, and you have the detection risk. Of these 3 risks, only one belongs to the auditor. Only one can the auditor handle. The other 2. So let's start. You get to know in the course of the discussion. The first component of audit risk is the what? Inherent risk. When you say something is inherent, what does it mean? Inherent risk is a risk that exists due to their what? Due to their nature. You cannot do anything about it. It's the nature. When you say you work in a bank now, if you work in a bank, what is that risk that is very common when you work in a bank? That you are a staff of a bank, particularly you are the front desk, the teller. What is that main risk that can happen? That risk is called privilege. That is when customers come to lodge. There's every tendency that the teller, I'm not saying they do, but the teller has every tendency to take some or part of that money. So that risk is always there because it's money. Okay? And you know that it takes someone that has integrity not to be tempted by money. When you see huge money every day, and maybe that teller does not have up to certain amount of money in his or her own account, and he's seeing this money every day. One day might say, let me try and see whether I can get away with this thing, and the person will try. All right? So that's what we mean by inherent. It's always there by their nature. All right? So when we talk about inherent risk here, in this circumstance here, we are looking at as a client, right? There are some inherent risk that exists in a client business. Particularly, it relates to the financial statement that the auditor is examining. There are some risks that entails in the financial statement. So let me look at because if these inherent risks are not considered, right? At the end of the day, it's going to impact negatively the auditor's opinion. And at the end of the day, the audit risk will be what? Will be very, very high. Then how do I know? So let's look at some of them. I'm just going to, because of that, I'm not going to waste so much time. Let me just give you some instances. Number 1, look at your non-current assets. Now, what does the law says? What does the standard says about your non-current asset? Particularly, if you go to IAS 36, that talks about what impairment said. At least once a year, you must test your assets, non-current asset, against what? Against the impairment, at least once a year. Because you want to be sure that the carrying amount or the recoverable value of that asset has not been materially what? Affected. For instance, you have assets. Last year, they have not started this Lagos Calabar Expressway, and that's where you have your asset, your building that is there. Now, this Lagos Calabar Highway is on, and because of that construction, right, the value of the asset in that axis will do what? Will rise. So maybe the value of the asset you have in your business last year was 50 million. Because of what they have done now, the value of the asset has gone to 200 million. But you have not tested your non-current asset against what? Impairment. You still left it at 50 million in your books. So what are you doing? What you are doing is that you are misleading the economic decisions of the users of financial information. You are misleading them because they are going to take decisions based on what you have in the financial statement, not knowing that the value of building in the non-current asset as what? As appreciated. You understand? That's one of the ways where I said that as an auditor is beyond the auditor's control. Right? Another one I can also lay my hands on is for the inventory. Now, inventory, according to IAS 2, right? IAS 2 that talks about inventory, it says that when you are trying to value your inventory, there are two recommended costing methods that you can use. Either you use first in, first out, or you use what? Weighted average. But your clients, when they are valuing their inventory, when they are costing their inventory, they costed the inventory using what? Last in, first out. Or they use base stock, or they use standard costing to value their inventory. What have they done? What they have done is that, in a way, that costing method has directly or indirectly affected the account balances of inventory in the same financial position. Do you understand? So all of these examples are inherent. Examples of what? Inherent risk. Do you understand? So as an auditor, it's beyond your control, right? Yes, you are going to ask questions. Yes, you are going to perform your audit test. But these are what has been done even before you pick up the engagements to start with. They've already prepared the financial statement. They've already prepared the financial statement. Okay? So you are just doing what? You are just examining it. And before you be able to examine that, that means you must have demonstrated due care, skill, and diligence when performing the audit. Otherwise, some of these things you will not be able to see them. But what you can do in that instance is to be able to reduce it. Let them know that the value of the building in the non-current asset is what has been affected or has been impaired materially. So they need to perform an impairment test. All right? That's for the inherent risk. I hope you understand. Okay, so let's go to another second one. Control risk. What do you call it control risk? So control risk has to do with the risk that the internal control system puts in place we fail to what? We fail to detect. I take it again. Control risk is the risk that the internal control system put in place by the client. We do what? We fail to what? To detect or to prevent. That is the risk reward will happen. Now, what do we mean? So let me give some instance. So in your SOP, in the finance and account SOP of your client organization, they said that every procurement that is above 1 million naira must be accompanied with a local purchase order. Right? That's what they have in their SOP. But they discovered that while the auditor was sampling their purchases or their invoices, they did not see out of 100 invoices sampled, only 2. Out of invoices sampled that are over 1 million, only 2 complied with that SOP directive. What does that mean? What that implies is that the internal control system is what? Is weak. All right? That's what we mean by that. So as an auditor, you need to also be able to let them know that this is what you have in your SOP, but what you are doing is contrary to what you have in your SOP. Can you give us the reasons why? That's why I said that as an auditor, you need to first of all review, gain understanding of your client before you start the audit, because you cannot give what you don't have. All right? That's the second one. So whether it's inherent risk or control risk, these two risks, they are outside the control of the auditor. That is, the auditor, in the course of performing the audit, he might detect this risk, but he's not the one that has control over them. All right? That's why we call them the risks that are outside the control of the external auditor. Now, the main one that is within the control of the external auditor is one we call the detection risk. Is that one that we do what? We call the what? The detection risk. What do we mean by calling detection risk? Now, this is the risk that all the audit tests and procedures that have been performed by the auditor will fail to detect a misstatement or a fraud or an error in a what? In the account balance. I think again, this is the risk that the audit tests and procedures that has been performed by the auditor will fail to detect any misstatement in the transactions that you have in the financial statements or in account balances. Okay? So what do we do? So what that implies is that if the auditor is not well grounded, then this detection risk will be what? Will be evident. I take it again. Where the auditor is not grounded, is not knowledgeable about the client business, right? The detection risk will be what? Will be very, very obvious. All right? So one of the ways to reduce the detection risk is to increase your sample size as an auditor. The more samples you take, the larger your samples, the less likely the test will fail. All right? What that implies is that as an auditor, you need to perform your test, your audit test. Now, in performing this your audit test, is the result of the audit test that will lead you to say, okay, this is fine, this is not fine, until you are satisfied. And that is where the role of professional judgment comes in. So with the result you have, with your professional judgment, you'll be able to stay or conclude that, oh, I think I'm okay with this. All right? But if you are not okay, you still need to continue to do the test until you achieve the result. Remember, I said something that audit is scientific. And you agree with me that in science, when you are expecting a particular result and you have not gotten that result, you keep trying until you get that result. The same thing is applicable in audit. So you perform your test and the test does not yield the desired result or expectation, you need to continue to doing it. All right? So, of these 3 risks now, the only one that is within the control of the auditor is detection risk. That is only when he's not knowledgeable about the client business. But if he's not knowledgeable about the client business, this will disappear. But the other 2 will exist. So as an auditor, when you are going for your audit, you need to be mindful that these 3 risks exist. That is, these audit risks exist. And embedded in the audit risks are these 3 components. So when you are going for the audit, you must have in the back of your mind that there is high inherent risk. That's the procedure. That's the way to go. Make up your mind that there is high inherent risk, there is high control risk, and there is less detection risk. Because these 2 risks, inherent and control risk, they go in the same direction. If inherent risk is high, definitely control risk will also be high. And vice versa. When inherent risk and control risk are high, detection risk is always very low, and vice versa. So what am I trying to say? When I say inherent risk is high, what that means is that all those risks that I made mention of, that is, there's impairment, they have not performed impairment test, okay, on the non-current asset, also on some items in financial statement, then there is no internal control system. So when there's no internal control system, and when they've not performed the impairment test on some values of transactions or in financial statement, what that implies is that the inherent risk and the control risk will be what? Will be high. So as an auditor, as an external auditor, you need to know, okay, how do I mitigate this? How do I bring this level? How will I be able to reduce this to an acceptably low level? So in the course of performing your audit, like I said, that's where your attitude comes in. Your attitude of professional schedule will now come in. Okay, I need to exercise due care, skill, and diligence, be able to detect all these inherent and what control risk, and relay them to the management to see what they can do to reducing this. Because if these risks are reduced, definitely the audit risk will also be what? Will be impacted. And that's why we talk about the audit risk model. It's a model that is, when the inherent risk and control risk is high, detection risk will be low. And when the detection risk is high, inherent risk will be what? Inherent and control risk will be low. So that is the analogy of that audit risk model that we discussed about. Any question? Any question? Questions, comments, observation?
No, sir.
All right, so we continue. So we go to the next one. So what's the connection between business risk, financial statement risk, and audit risk? So let's look at it. Now, I'm going to take the three at a go. So first of all, I need to explain what you mean by each of them. What is business risk? Business risk is the risk that will prevent the organization from achieving their objective. Anything that prevents the organization from achieving their set objective is known as what? The business risk. What are financial statement risks? Financial statement risks are the risk that the financial statement contains some material misstatement. All right? Why audit risk is what we have just explained, is the risk that the auditor will present an inappropriate audit opinion. So what is the relationship between these three? Now, the first one that will exist, the one that will lead to other risks, is the first one we call the business risk. Once there's a business risk, right, in a way, it's going to it's going to lead to financial statement risk. And if care is not taken, it will also boil down to audit risk. All right. So what do I mean? So as a business owner, there are risks that you run or that are evident when you run your business because you want to make profit. Now, if there is a law, when the government passes law, there are times those laws will impact your business in a way that is going to reduce your profitability. So as a business owner, you're looking for ways, you're looking for loopholes in that law to be able to achieve your optimum profit. Let me give an instance. There was a time in this country, around that, I've forgotten the period, I think it's around that 2012, 2015, during the Buhari era, when his first tenure as a democratic leader. There was a time they passed a law. They said that they observed that Nigerians have high risk of diabetes. What did they do? They passed a law that they should not be importing sugar again. So any organization that wants to import sugar will pay high tariff. So that law, that process is what we call the sin tax. Sin task means that a law that is put in place to discourage the consumption of a particular item, we call it sin task. Just like people that take cigarettes or people that play betting. Let me explain. For those that smoke cigarettes, for those companies that manufacture cigarettes, do you know that they pay high tax rates because they don't want them to continue production of cigarettes. Because before now, while I was still very, very much younger, what we used to see on TV then is that smokers are liable to die young. But the last one I saw, they say smoking leads to throat cancer. That's what they have on their carton. That smokers are liable to having what? Throat cancer. But still, that did not discourage people, that the smokers or people that like to smoke, from continuing with that habit. And what the government has done is to raise the taxes so that to stop the consumption of cigarettes. Another one is betting. Do you know that all these betting companies we have in Nigeria, 66.6% of their profit is what goes to the government? Do you know that 66.6% of their is what goes to the government? But what the government is trying to do is that they want to discourage betting attitude or betting nature of Nigerians. But still, some people still indulge in it. So when you talk about syntax, right, as an organization, you look for loopholes in the system to see how you can manage it. And that is where we are now going to come up with some technologies or with some transactions such that you will be able to reduce the impact of that law in your profit. And that will give rise to what we call the financial statement risk. Okay? Because you are going to look for ways to circumvent or the loopholes, to explore the loopholes to the benefit of your organization, that you can maximize your profit or your returns. Okay? So you are going to do all what it takes as a business owner to incorporate certain information or certain transaction in your financial statement to accommodate or to substantiate that motive. Now, as an auditor that does not understand how the client business operates, you will agree with me that that auditor can also fall victim of not knowing what test to perform. And at the end of the day, the audit test and procedure will fail to detect this material misstatement, and the audit report will be rolled out to intended users, and they will invest. At the end of the day, they will lose their investment. I hope you can see the relationship between the business risk, financial statement risk, and audit risk. Okay, you can see the flow. That is what we mean by that. So all of that is what they have put in there, right? All of this is all what you have here is what I've just explained now. So you, as your own leisure time, or at your own leisure, you can go through it and again try to get a better perspective of this, what I've just said. But that's what I just explained to us now. The relationship between the three of them. Okay? Any question? Any
Yes,
comment? Please
yes,
ask your
sir. Sir,
question.
can you just explain my network? I was knocked up. I just came back. If you can
I think
just explain it.
explain
I
what?
mean
What
the
else?
relation, the business risk. My network went up.
I said
Business
I said the business risk is the ability of a business not being able to achieve the objective. Any factor that prevents an organization from achieving their objective or a business from achieving their objective is known as the business risk. All right. Then you have the financial statement risk that says that there are some material misstatements in there's I don't want to use the word in risk. There are some material misstatements, or there are some misstatements that are embedded in the financial statement. We call it financial statement risk, or that the financial statement does not project what it claimed to project or was supposed to project. That there are certain information in the financial statement that ought not to be there, but they are there. So we call the financial statement risk. Then we have the audit risk. And I said the audit risk is the risk that the auditor will give or issue an inappropriate audit opinion. And what I said is that there is a relationship between the three of them. That is, as a business owner, your main motive is to make profit. And when there are laws, or when laws are made, or when you face challenges as a business owner, right, you always look out for ways to mitigate those challenges, those risks. So at the end of the day, you will to have maximum returns on your what? On your investment, right? So by the time you start thinking of ingenious ways to maximize your profit, it's going to lead to financial statement risk, that you are going to come up with some transactions, with some information that they are going to impute in your financial statement just to be able to achieve the selfish purpose or selfish means of the business owner. And if peradventure you now have an external auditor that does not really have a good understanding of how the client business operates, that means he will not be able to detect this material misstatement or this misstatement as contained in financial statement, and is going to roll out the audit report. And intended users, investors, they are going to invest based on an audit report that is based on false or misleading information. That is what I just explained. I hope that is clear, Madam Winkos or Opoanya. Is that clear, Madam? Well, she has gone again. I think our network is not good. So we go to the next one. Any other question before we continue? Are we good?
Yes, sir, we're good.
All right, we go to the next one. Thank you. We go to the next one. I talk about three factors that the auditor will need to consider while drawing up his audit plan. The first one is the audit risk that we just explained. The second one is audit materiality. Now, what is audit materiality? Now, according to ISA 320, audit materiality is the omission or misstatement of an information that could influence the economic decisions of the users of the financial information. Okay? The omission or misstatement of an information that is so material that it can influence the economic decisions of the user's financial information. What does that mean? So first of all, you need to understand that materiality is part of planning. All right? You need to have that understanding. Then number two, you need to have an understanding that once just like the audit plan, audit materiality also is not static. Okay? It's not also what? It's not static. The number three, materiality, audit materiality, right, is subjective. What do I mean by subjective? So what I consider as material, somebody else might not consider it as material. For instance, if I lost 1,000 naira now, I might feel very, very unhappy. It might affect my mood throughout the whole day. But somebody else will lose 10,000 naira. You will not lose any sleep over that. That's an example of what we mean by subjectivity of materiality. All right. Then you also need to have an understanding that as an auditor, because the auditor will not be able to review all the aspects of the financial statement, right? He will not be able to review all the aspects of the financial. So he needs to improvise, look for ways to be able to give some reasonable assurance level to the client that, okay, even though I couldn't look through everything, but to a very reasonable extent or to a large extent, I can tell you for free that the audit report I'm giving to you or the financial statement that I've examined does not contain any material misstatement. One of the things that can make the auditor to come up with that assurance is what we call the audit materiality. All right. So audit materiality, like I explained earlier, is one of those areas that the auditor used to factor into his audit plan. So before he set out to do the audit, he first of all look at the audit plan and you look at the audit materiality. What are the areas that I need to focus on? So in audit materiality, it focuses on 3 areas, and you can use any of the 3. You are not expected to use all the 3, but you can use any of the 3. Number 1 is revenue. Number 2 is profit before income and taxes. Number 3 is total assets. These are the 3 areas the auditor can place his audit materiality, or he can test his audit materiality. Those 3 areas: revenue, profit before interest and taxes, and total assets. Those are the 3 areas. Now, every audit firm has their own materiality method or approach that they use. We call it materiality threshold. Now, this materiality threshold, like I said, it exists based on what? A rule of the thumb. What do you mean by a rule of the thumb? Rule of the thumb means something that has been in practice over the years and has become acceptable as a norm. It's what we call rule of the thumb. So, what do I mean? So, for instance, if you have a baby, or if you have seen when babies start having hiccups in Nigeria, I don't know what they do in outside country. In Nigeria, when babies start having, what do? We take a thread from his or her clothing and place it on her hair or his hair. What happens? The hiccups stops. We don't know the magic. Nobody can explain to us what magic or the science behind that. Nobody. But we know that the thing stops. That's the rule of the thumb. All right? Does not have any science. Nobody can explain the science to anybody. But it has been passed on from generation to generation, and we all have also incorporated it in our own families. Okay? That's an example of what we mean by rule of the thumb. So different audit firms have different materiality threshold. So what you need to note here is that before the auditor set out to do the audit, he has already calculated his audit materiality threshold. And that is the one we call the overall materiality. That's one that the auditor decides before he sets out to the client office or premises or environment to conduct the audit is known as the overall materiality. Okay? So how does he get that? So that's why you see that for those of us that are that have the experience of external auditors, when they come, what they normally request for? They request for your trial balance and financial statement. Why they are requesting for your trial balance and financial statement? They're able to determine your audit materiality. They're able to compute or calculate your audit materiality. Before they set out to come to your office, they will have done theirs from their end. And like I said, they are going to calculate the materiality using any of these 3 areas: revenue, probably before interest and taxes, or total assets. Now, like I said also, whether it's audit plan, whether it's audit materiality, it is not static. It can change. So, for instance, the auditor has assured himself or herself that while he was calculating or while he was setting the audit materiality, he has said that when I get to the client office, for me to be sure that the revenue is accurate, I must get at least 20 samples of their sales invoices or sales transactions. Okay, to be sure that the revenue that they have posted as revenue is accurate. Now, these are the examples before he set out. Now, on getting to the client office, he looks at the revenue. He decides to conduct the sample, and he now discovered that, let's say, he wants to verify, he wants to ascertain some values of their revenue. Let's say the revenue for the trial balance is 1 billion, for instance, right? And he wants to say that I must be able to obtain like maybe 20 different sales invoices, that huge one that is material, right? I can use to substantiate this 1 billion naira because I cannot look at all the invoices from January to December. Okay? So when it gets to the client's office, discover that most of the invoices that he could lay his hands on, they are not even they are not much. The values are not huge. The number two, the client have some documentation issues, challenges that they don't keep proper records. All right. So as an auditor, you know there's a limitation in that. That means you are set out to obtain 20 samples. What that implies is that at the end of the day, you might only be able to get like maybe 10. And when you get 10, that means that you cannot give a reasonable level of assurance. What will you do as an auditor? As an auditor, you need to what? Improvise. What do I mean by improvise? You might need to reduce your what? You might need to reduce the value. For instance, you want to get like maybe 20, that at the end of the day, you'll be able to get like maybe 500 million. You might not say, okay, let me get more. Maybe the ones I can see, I could see maybe more of, let's say, 300,000, for instance. Okay, I can see more of 300,000 invoices. So I'll need to extend, I need to reduce my, what is it called? My materiality threshold to towards to 300. Now, what you are trying to do is that you set out to achieve 20, obtain 20, but you're able to get 10, and 10 will not suffice. What do you now do? When you get to the result that, oh, you can get more of those lower invoices. So what did you now do? You now decided to say, okay, so let me reduce my maturity threshold, right? Let me reduce it from 500 million to 300 million. And let me see if I can lay hands on some of these invoices. So that means I'm going to get more. Rather than going to be looking at 20, maybe in this instance, I'll be looking for like 35 invoices. And in a way, I was able to get 35 of those amounts that made up that amount, 500 million. 300 million, okay? So what have I done in that instance? What I've done is what I set out to do from the audit firm. I could not actualize it when I get to the client's environment, but I was able to improvise. That improvisation I did is what is known as what? Performance materiality. That technique I use by reducing my overall audit materiality to reflect my reality in the client business environment is known as what? Performance materiality. Another way you can look at it is this. So you know that if someone wants to perpetrate fraud in an organization, you know that auditors, they are not, the aim of auditing is not to detect fraud. The main duty of auditing is to ensure that financial statements are prepared in line with applicable financial regulatory framework. That's the main essence, right? But in the course of performing the audit, the auditor also need to have an attitude of operational skepticism that fraud may occur. And when fraud occurs, the management or the staff, the preparers of financial statements, right? They also would not like to be detected. That is, there are ways to be detected, to be found out. What would they do? They are going to look for ways to hide their what? Their clandestine transactions, secret transactions. For instance, they want to verify fraud now. They know that later will be looking out for big figures, right? But they will now decide to reduce the figure. For instance, the calculator is looking for maybe 1 million and above, but they have calculated fraud to the tune of trying to break down that 1 million into, let's say, 500,000, 200,000, 300,000. The think that auditor will not look at that. But not knowing that auditor, we aggregate individually and collectively to be sure that there is no fraud in that transaction. Do you understand what I'm saying? So all of these the auditor is trying to do is to ensure that there is no what? There is no fraud in the system. Do you understand? Sorry for that. It's my environment or so. So do you understand what I'm saying? Is that clear? Do you understand that that principle of audit materiality. Are we together?
Yes, sir.
Yes, sir.
Okay, so let's go. I'm coming. I want to try and lock the window. All right. So since we have that understanding, so thank you so much. So we move ahead. Now,
Hello, sir.
yes, I'm with you. Ask your question, please.
Please, I'm trying to be moving with the material so that we can be able to assimilate and be reading where you are.
Okay, no problem. No problem. I'm moving. I see that I'm moving now. I'm going to the next one now. So we are done with the second one, audit materiality. We go to the next one. The last aspect, that is how the environment will impact the audit engagement, particularly if the client is working in a computer-based environment. And that's where we're talking about computer in auditing. Okay? Now, computer system affect the audit process in two ways. Number one, the auditor may use computer system to perform his work. The number two, the client account system may be computerized. Okay? So these are the two ways that this is going to impact the auditor's activity. Now, when you use computers to perform your audit as an auditor, that means your computer is already programmed with certain audit tools, certain softwares. That is, when they send soft copies of some of these financial statements to your company's financial statement to you, either way to be looking at them physically or trying to calculate manually, just by um, deploying your computer tools, your analytical tools like your Excel, like AI to analyze financial information being presented, you'll be able to work smarter and be able to get the work done faster. Right? That is what we mean by that. So as an auditor, the auditors of 2026 of this new generation or the new generation auditor we have now, they don't work manually. Right? Their systems have already been programmed with all softwares that they need. So audit software that they can use, they have the audit command language, they have the caseware, they have others that they can also use. Okay. So as an auditor, before you set out, you will have been trained on how to use all of these things so that you'll be able to meet up with the timeline that you have agreed with your client. Okay? So it also enables the managers, because everything is online, right? You can have a review of whatever you have done. They give you tasks to do. So when you are done, you can have online meeting to review the task and be able to understand what are the challenges you face and how you can resolve those challenges, how you can remediate those challenges. Okay? So that is where that comes in. Now, also, as an auditor, when you're auditing your client, you must also be mindful that your system must be what? Must be properly secured so that nobody will have access to the information. Don't forget that your system does not only contain that your client's information, because you work in an audit firm and you have different clients on that laptops or on the systems. So you must password your system such that the information remains what? Confidential. And you must also ensure that you don't obtain files from your client that will do what? That will corrupt your information you have already stored on your system. Because when you obtain files from your client, some of those flash, you see that if you are very observant, most audit firms now, they have disabled the USB drive on their laptops. The essence is that they don't want viruses to come into their system. All right? So they don't allow. All right. So those are the things you need to also guide against. Then, as an auditor, also, for everything that you do on your system, there is a back end to it. Somebody should not have access to the information from the back end because there's what we call the audit trail. Now, the audit trail, even if somebody decides to tamper with your information, the audit trail will provide answers to who, when, and how that accessibility was performed or was achieved. Because like I said, it's something that happens at the back end. Not everybody have the dexterity to work at the back end of a computer system. So when there are issues like that, they're going to call in the IT engineers or computer engineers to investigate, to troubleshoot what led to what, and be able to come up with ways to forestall future reoccurrences. All right. So as an auditor, you have for your information you have in your system, there are two ways you can control them. You have the general controls on your system and you have the application controls. Now, general controls, as name imply, are those controls, right, over the environment in which the computer-based information system is designed, developed, operated, and what? Maintained. So, for instance, what that implies is this: when you are going out to your client environment, first of all, you must ensure that you keep the laptops or your system in a well-protected bag. That's why they provide you with a backpack that you keep your system. Even when it rains, unless you open that bag, your system will not be affected by whatever rain. Okay? Number two, they also ensure that when you get to your client's business environment, you don't sit in a place that is exposed to weather. For instance, whether exposed to sun or exposed to rain, because either of the two could impact your system, could damage your system if it's too much. All right? And another thing you also need to note here is that you must not put your system in a place where you know that somebody could tamper with information, even with the password, even if you put password. Some people, there's what we call keyloggers, that they watch you as you key in your password. And when you are not there, they are going to improvise and gain access to your system, information on your system. So you need to be mindful of where you keep your laptop when you go to work in your client business. Then also the use of password. That's why they always say that when you are using password, you must have a combination alphanumeric and special characters. Because it has been proven that if you use all numbers, numeric, or you use all alphabets, right, it takes just few hours for the hacker to hack into your system. For instance, if I put my name, Adebayo, as my password now, anybody that wants to access my system, just give the person maybe 3 or 4 hours. It will break into my system. If I use 1, 2, 3, 4, 5, 6, 7, 8, it takes the person maybe 4 hours to hack into my system. But if I combine Ade at 1, 2, 3, special character, it will take, if not months or years, before the person can decode my password. Why? Because I've made it complex for that person. So all what I just explained now are what we call general controls. Okay, they are what we call what? General controls that the auditor need to what? We need to check. All right. And not only for the auditor himself alone, even when you get to your client's business, you must look out for all of these things as well. That is your client business, your client's environment, the systems they have there, they are not exposed to all those dangers as well. Because you need to put that in your report. For instance, maybe you saw that your client he puts his system or a system close to where it's raining. That is what you can flag. I put it in your report that the computer system should be safeguarded. All right. Then we have what we call application controls. Now, general control is what I just explained that relates to the environment. But in the case of application control, it relates to the applications that are installed on your system. They are specific to application on the system. Now, just like your phone, on your phone you have WhatsApp. On your phone you have other social media handle, right? Just like your phone is your laptop. So each of these applications, you are expected to reduce accessibility to the information you have on these applications. So in your laptop, you have Excel. What that implies is that before somebody can log into your Excel file, you must have passworded it. Yes, the person can gain access to your laptop. Yes, he will be able to access your Windows. But when you try to alter information on your on the system, the application on your system, it will meet a gridlock. So that means your applications need to also be what? Need to be secured. All right? Such as your your ERP that you are using. Remember that when you want to, for those of us that understand what I'm saying, I want to be everybody uses system, right? So if you have an ERP in your organization now, you know that when you log on to the system through the window, when you click on the app that takes you to your ERP, you see request for your password. That's what we are trying to say. Not that you should use the same password for your window for your ERP. If you do that, that's what we call single sign-on failures. That means somebody can access everything on your system just by knowing just one password. Okay? So what we are saying here is that you must have different passwords for your system and for the one for the application. It must not be the same. So as to reduce loss or theft or damage to the information you have on the system. Okay? So you must ensure. So the purpose of the application control is to provide assurance that process transactions have been properly authorized and process of data is complete, accurate, and timely. So what that implies is that as you are doing that for yourself, like I said, you check that for your system, for your client as well. So if your client says they have, that's what you say that when they go for, they ask you, what ERP or what accounting package do you use? Sometimes they request for access to those applications or to the ERP because they want to see that there are no loopholes in the process flow on the application. Because if there is a gap on the process flow of the application, they will need to report it. It is one part of their management letter they are going to issue at the end of the day. Okay? So the auditor will be in the best position to advise them on this. Now, that is the aspect of the control. Then the next thing we need to look at is what we call COBIT. Now, what is COBIT? Now, COBIT is control objective for information and related technology. Now, first you need to understand here is this. COBIT is not something that you can see. It's not like your password. It's not like a general control, application control. It's something that happens at the back end. It's an IT governance tool. Okay? The whole essence of this is to be able to what? To provide for what? Data integrity and what? Security. The main essence of having COBIT is to ensure what? Data integrity and what? Security. What do I mean by this? So you go to Jumia or you go to Amazon, you want to buy stuff. You want to buy Apple phone, the latest Apple phone, right? And you saw it. Thank God I saw it. They have 20 left. You subscribe, you made payment. After you made payment, you now click for them to start to ship to Nigeria. Now tell you that they're out of stock. What has happened? That means the system has been what? As the system does not guarantee, does not have trust. There's no integrity on the system. That's what it means. Because if we had seen that you saw zero as quantity left, you wouldn't have paid. You will have waited for when there is a reorder before you now say, okay, let me make payment. But you saw that they said 20 left. That means you can still buy one and there will still be a reminder, right? But after you make payment, they now tell you that, sorry, you're out of stock. What does that say to you? That means they have scammed you, right? That's what we mean by data integrity. So this COBIT, what it tries to do, it tries to promote data integrity and security. Now, in IT, there are three things that are very, very important. Number one is confidentiality. Number two is integrity. Number three is availability. In IT world, there are three things that are very, very important. Confidentiality, integrity, and availability. What is confidentiality? Now, any information that is private to you that you post on the internet, right? That information should not be leaked unless you are the one that leaked that information. For instance, you are buying something on Amazon, you provide your credit card details. Now, that information should only be known to you and the Amazon itself, right? Now, but after you have made your purchase, you have already closed the app, Amazon app, and while you are sleeping, you started receiving debit alert, bagan, all the money in your account was taken away. That means that system does not guarantee confidentiality. What that implies is that as at the time you are providing that your information, your credit card details, what you're supposed to do is that information should be what? Should have been what? Encrypted. So that nobody will be able to sniff on the internet your information. They're able to encapsulate your information. That we call confidentiality. Integrity, I've explained integrity. The another one is availability. When last have you gone to Google and tell you that sorry, we have network issue? How many times have you seen that happen? It has never happened, right? That's what we mean by availability. Or you want to book a ticket, or you want to use Emirates and tell you that sorry, our server is down. Does that happen? Maybe once in a while, but it rarely happens. That what we mean by availability. So at all times, right, your internet, your IT, your website should be up and running 24/7. Particularly if your website has been created or developed for commercial purposes, like for businesses. So what this COVID does is to guarantee, like I said, data security and data integrity. All right. So what it does again is that it provides management and business process owners with an information that relates to IT governance that helps in understanding and managing the risks associated with what? With IT. All right. Such as what? Integrity of information and information system. All right. So, like I said, OBIT is not something that is visible. It is used by those who have the primary responsibility for business processes and technology. So it's for the people that design the business processes and technology. So at the point of development of your website, that is when COBIT will be incorporated at the design stage, not when the website has been completed. While you are working on the website, trying to develop it, that's when you are going to factor in COBIT. Is that clear? So that is what it does. What it does at the end of the day is that it's going to provide quality, reliability, and control of the information technology. Okay? Now, COBIT has evolved over the years. Okay? COBIT has done what? Has evolved over the years. It's not where it is today that it started from, right? But it has evolved over the years. So COBIT has components, about 34 components that it has. Then it has 34 components, right? But there are some that we call those ones the germane ones. Those ones are the 6 out of those 34 components or objectives, right? There are 6 specific ones that you need to talk about. So, what are the 6? The 6 are number 1, management guidelines. What does that mean? What that implies is before you agree, you need to first of all ask yourself, what do you want the COVID to do for your business? Because at the end of the day, what COVID does eventually is to align your business objective with your IT objectives. What did I say? It aligns your business objective with your IT objective. So for instance, you plan to have your business domicile in Nigeria, but you want to have affiliation with international customers. What do? You develop your website. You want to be transacting, you're in business like Konga and Jumia. You want people to patronize you. So at the point of developing your website, you need to factor in how you want COVID to achieve that your business objective. Okay? Now, when the business objective has been designed, is what we call when the business objective and the IT objective have aligned, is what we call the management guidelines. But when that has been done, from time to time, reports will be generated. Okay? Reports will be what? Be generated from the back end, but it will be to the business owners or the process owners. Now, this report is always is very, very brief. So because the process owner do not have the luxury of time to look through pages upon pages, tens of pages or thousands of pages of reports. So the one that they are going to develop for them is what we call snapshots, or we call it executive summary. It just contains information in the report in a summarized version, so that at a glance, the business owner can understand whether the COVID is achieving his business objective or what or not. All right. Then in the course of developing this objective, right, you must ensure that you go in line with the framework. That's what we call IT framework, IT governance framework of COVID. COVID has its own governance, just as we have IFRS, National Financial Reporting Standard Framework, or ISB framework. We have it in financial reporting. The same thing, that something similar is what we have in COVID. So they have their own framework that you need to follow. All right. Then you need to set your control objectives. What are those things you intend to achieve? What are those things you want COVID to achieve for your business in the information technology? You need to set it up. Then, at the end of the day, you need to now check. At the end of the day, you need to now test, assess, evaluate whether you are actually achieving, whether the COVID is actually achieving those objectives for your organization. That is when the audit guideline will come in. You need to develop the guideline on how you are going to track this and be sure that at the end of the day, you have value for your what? For your investment. All right? Then you need to also look at how you are going to incorporate. What are the tool sets you are going to incorporate into that COVID, able to achieve your what? Your control objective. That is what we talk about, the implementation tool set. All right? These are the 6 components, main components. Any question? Question, comment? We are good, right? That takes us to the next one, which is what? Computer assisted audit techniques, CAT. Now, what do you mean by CAT? CAT relates to techniques that enable the auditor to use computer system as a source of generating audit evidence. So like I said, most of what the auditors do now, they are done on the system. They are done what? On the system. So most audit firms, they have invested so much in what? In systems, such that if not all, most of the systems in audit firm, they have inbuilt audit softwares, tools, basically, just to make the audit engagement seamless and faster. All right. So there are 2 types of CATs. We have the audit software and we have the test data. Now, what's the difference between the two? Now, like I said, both of them, their target, the main objective is to use them to obtain information on behalf of the client. So we are going to use them to generate audit evidence for the purpose of the engagement. Because at the end of the day, like I said, the auditor is going to write a report, and the report the auditor will write is based on the evidence he or she has been able to what? To obtain. So like I said, there are two types. We have the audit software, we have the test data. What's the difference between the two? Now, let's look at the audit software. Now, the audit software, as the name implies, just like your antivirus, it is installed on your client system. All right? It is installed on your client system. And once it's installed, what does it do? The auditor will now be able to access information on the client server remotely. I take it again. The auditor would be able to retrieve or obtain information from the client server remotely. All right? So there are different types of audit software. We have the interrogation programs. What that does is that it's installed on your client system, able to access the client files and record, especially during audit. Okay? Then we have the interactive software. What this does is that it is used in interrogation of online computer system. So it allows for dialogue to happen, to occur between the client system and the auditor. Okay? So we have what we call the interactive software. So what that implies is that you know that for you to communicate on the system, you cannot use normal English to communicate, for systems to communicate. That's what we call machine learning language. Some of them is the SQL, structured query language, okay, the Python language. These are some of the languages that the computer system understands. So, for you to be able to use this very well, you must have ground knowledge on what? SQL or Python language, all right, and any other language that we know. Then the third type of audit software is what we call the resident code or embedded software. What this does is that, like I said, it is installed on the client server, and once it's installed, the auditor can track, can retrieve, can obtain any information that relates to the what? To the client business. All right. So basically, what we are saying here is that this software is used as to substantiate that something has happened or something has not happened. It's a tool that you can use to substantiate. Okay, it's a tool that you can use to prove beyond reasonable doubt that something has happened or something has not happened. So if you ask certain information from the client and the client is not coming up with the information, since you have access to this, you can go there and confirm whether what they have said is true or not. All right. So it's basically used for when the auditor is trying to obtain information, particularly that relates to we call it a test of detailed transaction. Okay. You know, it's trying to obtain verifiable evidence. That's when you talk about the audit software. Now, the second one is the test data. Now, the test data, as name implies, is primarily used as a test of control. That is, what that implies is that the auditor, before he starts the audit, right, he will need to perform some tests. And some of what he can use at that instance is what we call the test data. Okay? So the test data is a pre-audit tool. Okay? Before the audit starts, the auditor will perform some tests. And one of the tests he performs is called the test of control. He will test whether the internal control system is working. What do we mean? So let me give an instance. So let's give an instance. So you have some information. Let's say you have some figures or some numbers, right? You want to add up. Now you have your calculator. You have added it up with your calculator. And you want to be sure whether the calculator is correct. What do you now do? You now take that information to the system and now ask the system to perform that same function, adding up. And then we are now going to compare what you did with your calculator and what you did on the system. If we arrive at the same value, that means that the information on the system is what is accurate. Do you understand? So it's a test of the existing control on the client system. You want to be sure that the information that all they have posted on the system can be relied upon. So you are going to perform that test of control. That is when the test data comes in. Okay? So it's the way to show whether the auditor can rely on, because anything that has to do with audit is subject to what the auditor can see, what the auditor, what is verifiable. So if the auditor cannot validate it, then it does not exist. So that is what you use the test data to do. Hope that is clear. So this embedded audit facility is the same as the resident code. Okay, it's the same, just like resident code. Okay, so let's look at the advantages of this cart. What does it do? Number one, it makes the auditor to process large number of data or transactions. So with cart, the auditor can work on both structured and unstructured data because it has that capabilities. Number two, it also assists in testing the completeness and accuracy of the electronic processing itself, like the test data. You want to be sure that what they have given you, what they say the system can do, truly the system can do it. Okay? Number three, it allows the auditor to test the effectiveness and efficiency of the internal control system. And that is also made possible because of the test data. You'll be able to test that this control that they have put in place is it actually working or not. Okay? That's another advantage of CAT. Okay? Then the number four is that it makes the audit to work smarter and work agreed with with the timeline with the client. Because it makes the work to be faster. What the auditor will have used like 4 days, 1 week to do. With this software, the auditor can do them within a couple of days. And it will have saved some time. Okay? Now, what are the disadvantages? Number one, it's very expensive to purchase. It's not small money. Not that it's expensive like that, but because they are mostly denominated in foreign currency. I know that Nigerian naira to foreign currency is not the same. The dichotomy is wide, right? So that is why it's expensive. Okay. Number two, there's always update that needs to be to be run. You need to run update. Just like when you run update on your system. Once the update starts, every activity, every process will stop. That's when the update is done. Okay? Number three, it's sometimes the clients are unwilling to allow the audit firm to install this software on their system because it's as if they have full tracker on them. That means they are no longer safe. Nothing is they are no longer nothing is secret. They don't have privacy any longer. That's what it means. So most times they don't want them to have it installed, that they will not be tracking whatever they wanted. Okay? Then another disadvantage is that it's very, very difficult to train staff on it. Okay? You need to train staff on it. It's not something that you can just know. You have to undergo training. As a matter of fact, some audit firm, when they train their staff on the use of these cards, they make them to sign bond form. That is, if I train you, because what it does is that it enhances the value of the external auditor. Once you know how to use this card, what it does is that it enhances your value. So if the auditor value before the knowledge is, let's say, 200,000, once he has that knowledge now, his value will jump to maybe 2 million or 3 million. That was happens. So most time the client with the auditor, the managing partner of the firm, we ask before they train, we make the audit staff to sign bond form that after training, you're not going to leave immediately. And if you choose to leave, you have to pay back the training fee for that knowledge. So these are some of the disadvantages of what's it called? The CATs that we just talked about, computer assisted audit techniques. So that is all for chapter 7. Any question? Any comment? Any observation? Are we good to go?
Yes, sir.
All right, thank you very much. So we are done for today. Now, I want to believe that you have this question bank that provides an analysis of each of these chapters that we have discussed, right? So what I'm trying to say, go back to your Pathfinder from year, diet in, diet out. You see that they have provide be able to analyze the questions from question 1 to question 7. They be able to analyze those questions. Please take time to look for the ones that relates to or that pertains to chapter 7 that we just finished discussing now and attempt them. Okay? Attempt them. That's how you're able to know whether you are really gaining knowledge. Okay? Because at the end of the day, do not wait until when the exam is near. Okay? It's better you start your plan now and be able to achieve what you intend to achieve on time. All right? So go to that questions, attempt them. Then if you have any challenge, you have my number. You can put it on the platform. If you remember anybody that put something on the platform, in no time, we'll always respond. Okay? Because we believe it's a learning ground for everyone. Right? Even as I'm teaching, I'm also learning. So you post questions on the platform, we'll be willing to look through it and be able to provide answers to as appropriate as possible, so as to also give you some sense of belonging, because it could be discouraging sometimes when you put something on the platform and you see that this thing is there for months or for days or weeks, nobody attended to, but we don't do that on our platform. We always provide answers to those questions that have been asked. So if there are no questions, thank you so much for your time. The recording will be shared in no time, but you can still remind the management by putting on the platform that you are interested or you would like this recording to be shared as soon as possible, so that the management will reciprocate by putting it on the platform. And if you have any new student amongst us, you are welcome. You have not missed anything. When I say you have not missed anything, everything that we have discussed is recorded. So in case you miss out any, you can fall back on the lecture recording and you'll be well abreast of everything that we have done thus far. Okay? So if there are no questions and there are no comments and there are no observations, I will now draw the curtain on the class for tonight. To meet next time. Have a good evening.
Thank you, sir. Good night, sir.
Thank you, sir.
Good night.
Thank you, sir.